Hi, everyone. Welcome to the Latam Stocks Podcast. I'm your host, Patrick Flood. Today, I'm speaking with William Cordeiro. William's the managing partner at SaaSholic, a Brazilian early-stage venture capital firm. He's as plugged in as anyone to the Brazilian VC ecosystem, so it's going to be great to talk to him today and hear what's going on with venture capital and startups in Brazil. Hi, William. How are you?
Hey, Patrick. Thanks for having me in your podcast. It's a pleasure, man. Super nice.
I'm really excited to talk to you. I'm really interested in VC and the startup scene in Brazil, having lived in Sao Paulo for over 10 years. So I've seen it grow like crazy. And, I feel like you're kind of like a new breed of like a young guy comes out of college and goes right into the VC and startup scene, which, that wasn't really a thing 10 years ago. So I'm curious to hear your background.
You're right.
Yeah, I'm curious to hear about your background and like, why did you decide to do that?
Well, that was a nice question because, I've always worked in venture capital and I don't even know if there is something cooler to do because the way I started doing this was in a straightforward. Honestly, my connection with venture capital comes with a failed entrepreneur story, pretty much like that. I tried to start a business. It was back in college. And then one thing that I did back then was let me connect to everyone that is working venture capital, everyone that is working on startups, talking to CEOs of successful founders back then, the so-called successful founders. And what happened was I had a chance to grow this network and ask a lot of advice to people. And the company turns out not to be very successful, but it was the place where I learned the most when I remember my college times. And what happened next was a few mentors that I had. They were all alumni students from FGV. And FGV is like the fancy business school in Brazil. People say it's a Harvard in Brazil for business. I mean, of course, you have to put it on a perspective. But the thing was, I had the chance to learn a lot of successful guys like founders of startups such as Neon, which is a unicorn company, and others. And these guys, they were close, helping other entrepreneurs, other alumni students at FGV. And one of these guys, I was a guy called Rafael Belmonte, founder of a startup called Net Show Me. He ended up asking me William, now that your business didn't work, what do you think about learning more from the other side of the table? And it was everything new for me back then. I was returning from Stockholm. I studied almost a year back in Stockholm. It's a common thing that you have back at FGV. You have the chance to go for over a semester abroad. But I returned to this cool project, which was GV Angels. Essentially was, William, we want to gather high net worth individuals and accomplished founders that want to give it back to the community, people that want to invest in tech. We're talking 2016, 17. Yeah. That was what we were doing back then. And the whole idea was, okay, we have a WhatsApp group with 10 people. We're willing to meet entrepreneurs that want to raise capital. We want to have the best ones you can meet. And we also want you to connect with other alumni folks that have some dollars to invest alongside us. And that was the briefing. No background, nothing. It was okay, how can I hack this system to get together a high amount of great people that attended FGV back then, and now they're successful, and now they want to invest in startups. And long story short, we went from 10 to over 300 angel investors and over 50 angel investments back then. And it was super interesting back then to realize that it was what I call the third wave of venture capital in America. So you have this first wave, which was essentially there was no venture capital, crazy people doing things on the internet. And it was very hard to build a company back then. I mean, when it comes to raising VC dollars, at least. And then you had this second wave of venture capital, which was the moment when venture capital as the asset class started to come up like as this new allocation for the families. Like some of the like well-known like venture capitalists of today, they were the ones responsible to teach the families and to like show them what it was to invest and the risks and everything. But that was when companies such as like Olist and Pass and like that, those like billion-dollar companies, they were born in a moment that VC was still an emerging asset class. It wasn't mainstream. Like it is not mainstream. It will be very hard to be one day. But like we had like less than, let's say, three or four. I don't think we had like more than four like funds with over, say, 50, $80 million in assets under management. So that was sort of the reality. And the people doing venture capital was essentially very sophisticated, like institutional investors they were backing these VC firms, these emerging VC firms, and also some angel investors trying to do this new thing, trying to like find a new Facebook. That was what we were doing back then at GV Angels. So we had a bunch of people with a solid background in M&A, like corporate finance, like everything that you need for a disaster when you're investing in an early stage startup, because you try to have the very same terms and you try to design the deal for early stage companies pretty much like you were doing on like much larger companies. And we had to learn that fast. And that was when this second wave of venture capital started to show as a moment for people to get to know better how that thing worked. And we were like trying to look for benchmarks and talking to other VC firms back then. The whole idea of GV Angels was if we don't have friendly deal terms, if we don't add value to these founders, we will never co-invest with tier one VCs. So what we can do in terms of governance and everything so that we can have access to that pool of talented people. And I call it my like school. So that was where I actually started in venture capital. And I really liked it. It turns out it was a very nice experience. And moving fast forward a little bit more, back in 2019, I had a chance to meet my co-founders here at SaaSholic, the two other partners, Diego and Gustavo. So we are a partnership of equals here at SaaSholic. Diego was the founder of a B2B SaaS company called Rock Content. Gustavo was an early employee at Rock Content. So Diego was the guy with the hands dirty, doing everything from zero to Series A, Series B, and beyond. And Gustavo was the guy taking care of the sales team. He was responsible for building the outbound sales machine and managing hundreds of people in Brazil and in the US. And I am more the financial guy, sort of, came from that background of angel investing. And we were doing angel investments back then. It was a interesting experience, but pretty soon we decided that it would be interesting to have a investment vehicle where we could pull some capital from people that we admire and people that we have close to our network. And that was essentially how SaaSholic started. It was first as a blog back then. It was no venture capital. It was all about writing.
You started with content. You started with internet content.
Yeah.
And then you turned it into a fund. So you built the content and the audience first. And I guess the idea was to build trust with your investors. And this is what we're thinking about. And then eventually raise capital.
Patrick, to be honest, I think we never thought I would have to ask Diego, but I think at the very early stages of SaaSholic, it was all about how can we build a brand and how can we gather the SaaS community in Brazil? Because building companies in the cloud, it was a new thing. It was the equivalent of talking about AI back then in 2011 or 12, that kind of discussions. Everything was super new. So what Diego was doing back then was, okay, he was attending SaaSter, SaaS Talk, and all these places where like the people doing cool stuff in SaaS, they were like sharing their playbooks and everything. And he was writing to a Brazilian audience. It helped us a lot to get access as angel investors for sure, because that's how you build trust and people get to know you about the thing you were writing, right? But it was only like 2018, 19 when this idea came up. Like, okay, first, we've done a lot of angel investments. These companies are doing well. We've learned a lot, but how can we scale this as a nights and weekends project? Because Fund One wasn't a full-time job. We were actually investing some of our time on the weekends, on like on the like that was the whole idea.
So what was it like trying to raise the capital then? I'm curious, are most of your investors Brazilian, like similar to the GV Angels investor network, or do you talk to international investors too?
Oh, mostly Brazilians, I would say. Like perhaps we have like 5-7% of our LPs. They are US and Europeans.
How is the perspective then, now that you said, the third wave of venture capital in Brazil, how has it changed as an asset class? How does the Brazilian institutional investor, LPs, how do they view venture capital now compared to 5-10 years ago?
What changed was, let's say you were an American and you went to invest in Brazil, and you've heard a lot of news that in Brazil, like the political environment is probably not the very same of what you have in the US. The currency, like the economy and everything. So all of like these things, when you put it on the basket, will come up to the like foreign investor as something like, okay, I have to get a premium in order to take these amounts of risk because I'm investing here in the US, the largest economy in the world. And on top of that, you have the Brazilian bureaucracy and like the way the deals were structured and the corporate, like the Brazilian corporate law. And that was one of the most important things that changed and favored the ecosystem in Brazil, because back then, all the investments, the angel investments, they were done using a convertible note instrument that we call contratos de mútuo conversíveis. And the thing about the contratos de mútuos is that it was created as a sort of like as if I were lending money to the company with the option to convert that in equity. But when I decided to invest in the companies and when angel investors decided to start investing in these companies, they were hiring the lawyers that were used to do like more mature investments. So the deal terms, they were very different from one another. So imagine in the US, a moment where you didn't have the safes. So there were no standardized deal terms. So a company that raised the first round had a very particular investment instrument. And when the company graduated to the seed round, it had another very creative instrument. And when the company like progressed to the Series A, it had like a more complex, layered investment instrument.
Every round, it just gets more complex and more difficult.
Exactly. And when the foreign investors looked at it, they were like, if this is not like obvious, like super, very interesting, if the company is not growing like at least twice what we have in the median here in the US, I'm not even wasting my time because I'll have to spend a lot of money with the due diligence, trying to get to know local partners and everything. And what changed was the angel investment became more popular and the angel investors started to become more sophisticated as the first VC-backed companies started to exit, and these early employees started to reinvest their capital within other people in the ecosystem. And when they were choosing the investment terms, like the convertible notes or the saves and everything, they chose a more founder-friendly instrument because they knew that if I get too aggressive on this round, the subsequent investor will ask for the same stuff, and then the stacking of like complexities will be very high. And this is what I call like this new wave, the third wave of venture capital that starts like in 2018, 19, where you had like some interesting exits going around. And these people started to reinvest in these companies. And we even have this very popular corporate structure right now, which is the Cayman sandwich. So essentially, instead of having your investment directly in the operational company in Brazil, you invest in the Cayman holding that will own 100% of an LLC Delaware in the US, that will own 100% of the operational company in Brazil. But that structure will make it cheaper for emerging managers to deploy capital. It will be easier for the investors to raise capital. It will be more flexible for co-investments and so on and so forth. And that's how things change. And when the Series A investor looks at a Brazilian company right now, he will be confident and comfortable that the company raised all of its previous rounds as standard Y Combinator saves. Okay. And if that didn't happen, he will ask for the company to like change the convertibles, the mutuals and everything to saves, and then they will proceed with the conversion for a more like American familiar corporate structure. So it's not, that changes
it's not
everything.
Brazilian style anymore. It's an international standard, or closer to it at least.
Exactly. And same thing happened to the investors. To be a emerging manager in Brazil, you have to essentially you will have to raise your fund in like an offshore jurisdiction, because to like raise a fund within the Brazilian structures, it takes like a large pool of capital that ends up creating a hurdle for like new like emerging managers trying to prove themselves as good investors.
You can't raise
you can start small. That's the thing. Exactly. So SaaSholic Fund 1 was a very small fund. It was less than $2 million. And we had like, I don't know, like $20,000 of yearly maintenance.
That's it? I thought the Cayman
structures... Because it was everything...
I thought the Cayman structures were more expensive than that. You can do the Delaware LLC
Yeah, it will be more expensive. If you try to launch a proper fund, you will have to decide if you go to the Caymans or if you go to the Delaware structure. The funds usually are formed as limited partnerships in Delaware. And now you have a whole industry trying to bring more efficiency to this space, such as Angelis, Carta, Valban, those guys. You're automating everything. Because think from my perspective, I won't like have any edge into my business if my back office is super, super well structured. I can automate everything. I should invest my time investing in great companies, providing great value to these portfolio companies, supporting them to raise more capital and to grow their revenues. That's where the edge will differentiate us from other funds. And having these like ready to go structures makes our lives way more easier. And for the companies as well, like so many times when I was doing angel investments, the founders ended up in a situation that was, okay, we don't have a lead investor. We have 60% of the round soft committed. The angels, they told us that if we find a lead investors, they will commit and sign everything. Otherwise, they are out. And when you are in a safe investment, like the simple agreement for future equity, when you have these instruments that work similar to a convertible, but with the problem that you don't have the option to go to get your money back, it's only like 0 or 1. When you are in this structure, you have more flexibility to raise on the goal. Like, okay, you want to invest like $10,000, fine, sign here, wire the money. You want to invest $100,000, fine. I can have different caps, valuation caps. I can have a much more flexible structure because I know that the guy who will decide my corporate governance will be the Series A investor. And if I don't have maturity in terms of company, if I don't have enough revenues, if I don't have a product, if I don't have like anything built yet, I don't have to waste more time and my capital trying to build and draft all of these complexities. So that's a very big move for Latin American companies. And it is a thing that we are working hard to, bring the same concepts and transparency to the Brazilian regulators. Like, listen, we only have upside if we change our rules and if we make it more flexible. We are fostering innovation. More companies will start from now on. And that's what the United States has taught us. Like, it works, right?
It seems like Brazilian regulators have been pretty open-minded in terms of startups and VC. What do you think? I mean,
they are.
Yeah, I think they've been pretty decent.
Yeah, they are. I mean, Brazil is one of the most, if not the most sophisticated country when it comes to payments. PIX is a international benchmark for all countries. We have instant payments, but we were forged by our environment. We had a lot of fraud, so when it comes to transactions, they had to be safe. We had a lot of incentives to make things right in this space. But when it comes to the corporate structures that we have and like in a more broader sense of the way things operate, we still have a lot of room for improvements. Let me give you an example. Do you remember the convertible note I mentioned? I guess a convertible note, the way we call it, the contratos de mútuo, they were never ever presented to a judge. So then the judge could rule a situation for a company. And that's how crazy what that means. Let me explain it to you. Why, as an angel investor, I choose a convertible instrument? Because I want to be senior when it comes to liquidation, because this is a debt, because I don't want to be exposed and I don't want to share liabilities with this company because I'm not a shareholder yet. And because I want to have this flexible instrument in which if things go sour, I can force the company to repurchase my convertible note for $1, and then I am out of any sort of liabilities that this company might pursue. And this is a very complex thing, the way labor law and mostly labor law, how it works here in Brazil. And for that reason, we decided to invest using convertible notes. We in a broader sense, the angel investors from 2012 until now. But the problem is, some angel investors, they know that the convertible gives them the option to convert, but if things didn't go right, they will have the option to ask their money back because this is a convertible, right?
Yeah.
But what happens when the company is in a situation that the angel is considering to ask the money back? Probably the company is going to fail.
Right.
Angel investor, he's doing things totally wrong. He's got no idea what he's doing because when he reads the contract, he will say okay, I do have the right to ask the money back. But when you invested in a company, you were betting on the future of the company and the value of that equity. So you sign an agreement. It's this crazy thing. I signed this agreement that I wanted to have equity, but let's just start with that. And then 5 years later, if things get wrong and if the company fails or whatever, considering that me, the non-sophisticated angel investor, have this document that was signed, I have nothing to lose. So let me ask them my money back. And that is the whole problem of it. And when it comes to like the information I gave you, like never a judge has like reviewed these convertible. Like he can be very transparent and look at the document and say, look, this doesn't exist. You were all trying to like disconfigure this instrument because you are all shareholders, but you just want the upside of being a shareholder, but you don't want the downside of being a shareholder.
Right.
You see how complex that can be.
And it never actually went to court. It never actually went to court.
Yeah, that's why
there was no precedent, so no one knew if these contracts were even valid.
Exactly. It will be safer to reach an agreement and say, okay, let's just give up of this document. And when it comes to the safe, it's different. And the angel investor, he starts the game learning that, knowing that there will be only two options. If the company succeeds, he will convert. If the company fails, he's not converting, and he will never have the chance to ask the money. And when the angel investors try to be like founder friendly, they go like, okay, we have this contrato de mútuo, but let's reduce the interest or even remove the interest because I'm here for the equity. But if you do that, you are saying to the judge, like, look, another reason
it's an interest
for disconfigure this instrument. And it's still there is still a lot of progress to be made on that front. And the cool thing about it is that it is progressing fast. It is changing fast. So at SaaSholic, we only do Y Combinator standard safes. We have a side letter that is very transparent to the founders. Like, we're looking for pro rata, we are looking for information rights, and everything is standardized.
Right.
And that makes it easier for the founders to start a journey,
So let's talk a little bit more then, I guess, about the thesis at SaaSholic. So
cool.
Venture is growing really fast in Brazil across all industries, right? So why SaaS specifically? Why not focus on ed tech or ag tech or fintech, or why specifically SaaS only companies? And
cool.
What's the thesis?
Yeah, I heard that a lot. Why SaaSholic? So
it's right in your name, right? So you make it like you said with the transparency, right? Like it's right in the name. You know what you guys do right away.
Exactly. Yeah, we only do SaaS, but mostly we like recurring revenues, predictable revenue. That's what we like. Like healthy margins. But the idea of SaaSholic, as I mentioned earlier, it started as a blog, and it was like a lot of people, a community of SaaS entrepreneurs that were producing content related to SaaS companies because that was new, and sharing their learnings and getting together and trying to help each other. So that was pretty much how we started. And when we moved and decided to raise the fund, the idea was, okay, we have like over 10,000 hours doing this. We know that a SaaS company in the early stages, they have this beauty of early metrics. So it doesn't matter if the SaaS company that you are talking to is in the retail sector, working for the healthcare to whatever, but you will be able to understand how much churn that guy have, like what is net retention dollar, what is churn, what is expansion, contraction. You will understand like how the sales architecture works in the company, how many sales rep the guys have, what is the efficiency of these people, how much money these guys are making when it comes to revenue per head count. So there are a lot of proxies that you can compare an early stage SaaS company, which is very different from investing in like a consumer tech company, which is like the Facebooks and the TikToks and this is very hard. Of course, because it is very hard, when you have a great company, it will be explosive. It will be like a huge success. But for the SaaS world, you have more metrics and a more like fundamentalistic way of approaching things. And that was what we decided to do. Like I guess we know a thing or two when it comes to sales, when it comes to SaaS companies. Like Diego was scaling rock content, Gustavo, like before GV Angels, I was doing these angel investments with a very concentrated portfolio in SaaS companies. So let's help the founders with tactical knowledge, like things we learn, playbooks that we wrote and we know that they work. And it started as a like nights and weekends project, as I mentioned. And the cool things we learned when we started SaaSholic was like immediately in the first conversation, the founders were saying things such as, well, even though if you guys don't invest in us, this thing that was very interesting for us. I can try this immediately after this call, or that strategy, or that was cool.
You felt like you were adding value. You felt like you were adding value.
Exactly. Yeah. And it happened because most of the time when the founder is talking to the VC, being a venture capitalist, most of the time it means to be generalistic in some ways, because if you were trying to invest in things that don't exist yet, you probably don't have a background on that kind of stuff. But that was what we committed to the founders. Look, we guess that we know some things in SaaS. Come here, let's talk. I'll give you a fast go, and I mean, of course, go or no go, but we will take a decision faster because we know exactly what we're looking. And if we happen if we decided not to invest in your company, we will provide you a detailed feedback on the things that we don't like. And that was interesting for us for Fund 1. And we realized that we were having access to deals, co-investing with very interesting funds. And we were the best deal, in terms of it will be better to have these guys alongside us because they want to help, and they will be investing their time helping these founders with stuff that we don't know. That was part of the thesis of Redpoint. So Fund 1 was anchored by Redpoint. We were the only fund they invested here in Brazil. And part of the idea was, okay, let me first foster the community of SaaS entrepreneurs, because that will become deal flow for the fund. But secondly, let me have these guys close, because every time we need a very specific and tactical idea from someone that have been there, done that, we can ask these guys. And complementary to the Redpoint investment, we had other folks that were creating B2B SaaS companies here in Brazil, such as the founders of Melius, Hotmart, Simpla, Jito, the kind of founders who were operating and learning and iterating every day. And that was super cool, because we had these value prop to the founders, look, I'm not just money. And when it goes to, when we connect this to the investing perspective, it gives us some pricing power. Look, you're raising at X million valuation cap. But listen, I have more, not just money, but more than that to provide you. So I would be interested in joining your round at 0.9x with a 10% discount or that kind of stuff. Because that's the maximum that I can pay, and we will do this together. And it ended up being the best deal for these founders, because we went in and we created a lot of value together. We helped them raise more money than they expected in the subsequent rounds. And it was a great deal for everyone. Then that was when we realized, look, SaaSholic is probably something larger than we ever expected. It was the end of 2020, early 2021. Gustavo and we decided to go all in SaaSholic, and I left GV Angels back then. I started SaaSholic as an LP in the fund. We were doing this part-time, but officially in 2021. And Diego, he was part-time he was full-time rock content, part-time SaaSholic, because he's the infiltrated guy that we have, the founder with the hands dirty, operating his company. And it was when we raised the second fund. It was a $10 million fund from which we have invested like close to half of it. So we are essentially looking for companies in Latin America, preferably Brazil, but we can invest outside Brazil. The only reason why we would choose Brazil is because we have different networks here in Brazil, but we're super open to know other folks in Latam. But the idea was, okay, let's back ambitious founders with very interesting metrics, huge addressable markets, companies that are growing into what we call our very interesting companies, like when we compare to our data set. And we will be writing tickets up to $500,000 and providing the amount of support that these founders need from pre-seed until the IPO or whatever will happen to the company. And it's been like a blast. Every day it's like a challenge. We have a lot of cool stuff to do. We have a lot of like investment theses that we're very excited with. Companies that will be like very transformative to our economy. Yeah. And we think SaaS is still like everyone is talking about crypto and AI and everything, like so many cool stuff, but we still have the basics to solve in Brazil.
Yep.
And that's why we can see a lot of opportunities going on. And that's the kind of companies we like they're solving very interesting companies no one has ever touched, with a optionality to add or to embed a financial product on top of it, like on their Series A or Series B, and increase their addressable market and then become a winner into that category. That's the way we look at it.
So you mentioned an IPO, and I'm curious to ask you, what do you see for exits for startup companies in Brazil? And how has that changed since your time at GV Angels? I mean, you see IPOs, but they're down the past few years, and there's some M&A activity. So what kind of exits do you typically see, and how has that market evolved?
Cool. As a venture capitalist, you have to be optimistic about the future. If you don't do that, you should leave that's the wrong job.
Who needs an exit?
But
IPO is going to do so well that they're just going to dividend you till you're retired, right?
Yeah, I mean, the thing is, IPOs, we do expect some IPOs to happen within our portfolio companies. Otherwise, we would be doing it wrong. But we know, that is a very hard game. And when you look at the exits in Brazil, they have been changing. If you look at the companies that raised capital from 2013 to 2020, the median successful exit is towards $160 to $100 million. That's how much these companies will exit. It will be probably an M&A with any strategic, but you have to have this perspective that venture capital is not a business of medians and average, it's a business of outliers. So we do expect the companies to achieve extraordinary growth and go for an IPO, but we know that is a very hard game. So when we model our investments, what we look is this company, can I believe that this company will return my entire fund, considering the amount of money that I'm investing and considering the stage that I'm investing, the ownership that I have. So it's essentially what we're trying to understand. Everything that will comes after that is upside. So $10 million fund, if I have 5 companies that will return the fund, it will be a fund that will return 5x in US dollars. And we know that currency is another issue when it comes to returning money to your LPs. So that's how we look at it. We don't like to buy the hype because we don't have the mandate for doing that. It doesn't mean that I believe this is wrong. Some funds, they will play another game. They will have 50 assets and they will spray these investments into small checks, and they will look for 1 or 2 outsized returns. this investment will pay for the entire fund multiple times, and that's how they roll. What we think is, okay, if we are specialized in SaaS companies, we probably know a little bit more, or we spend more time trying to learn more about it. So we are comfortable in having a more concentrated fund. Thus, we expect a higher ownership in these companies. Thus, we expect to invest more of our time working with these founders. So we are not spraying capital within like a large number of companies. And I think both strategies ended up working. We like more what we're doing here.
Right.
And I think this is, I know like everyone will say that, but I think this is the right moment to do that. When you look at the companies in Latin America doing SaaS that raised over $50 million, I mean, we actually just started, like a couple of years ago. And when you look at the potential acquirers, they are compounding revenues every year. So like the potential acquirers, they're getting bigger. You will have more companies competing per deals. So probably that will end up in having like more interesting M&As coming up. And the market itself is maturing. So that's why we're very excited with SaaS in Latin America.
Yeah, that was an incredible overview of the market and everything. And do you want to highlight maybe a portfolio company and talk a little bit about that before we get you out? I mean, I had one that I know. I don't want to put you on the spot and pick one if maybe you're not ready to talk about it. But when I was listening to you talk, the one company I know that you guys have is ClickSign. And I've used it, and it seemed to fit everything you just talked about. It's now a proven model that works in Brazil. I'm sure they have revenues. I know they have revenues. I've paid for them, I think. And yeah, it seemed to fit everything. So, but if there's another one you want to highlight and talk about?
Yeah, I mean, we like all of our portfolio companies, and we believe that, I mean, what we're doing is very interesting. But what I can highlight is like companies that have a more direct relationship to what we've discussed, which is, okay, we still have like huge problems to solve in Latin America. So before thinking about AI and everything, so how can we just solve the problem?
Simple problem.
For example, we invested in a company called Yoga. Yoga is a vertical SaaS that is building the operational system for restaurants in Latin America. Yeah. So to give you more perspective, we have 1 million restaurants in Brazil. These restaurants, they are operating with pen and paper mostly. And the owner of a restaurant, the way he knows that his working capital is like below or higher than like 50-40% is by opening the fridge and seeing how much protein he's got in the fridge. And this guy can have a peace of mind that if he like get a software to do all the calculations and, like after that, providing him some like reports of what things are happening with the company, where he's spending more, what can he like save when it comes to buying and everything, that will be like transparent to the company. And what Yoga is doing is like they are helping the customers first with the like management, and they're sort of providing the ERP for the restaurant to operate. And then they're like expanding these into some other pains that the restaurant have, which is delivery. So how can we integrate Rappi, iFood, IQFomi, and all other players all together so then they know and they can conciliate everything. So next, how can we provide an interesting online menu? How can we provide technology for these merchants to have a smooth payment infrastructure? That's what they're doing, and they're growing like double digits every month, very capital efficient. The company went from like $0 to $3 million in ARR, raising less than $300,000, and they have like a huge market when it comes to payments to like bite a very small part of it to provide the full experience to the customer. And that, I mean, yeah. and they are not talking about like artificial intelligence from the beginning no, they're trying to solve the basics.
Yep.
Another company we've invested is Not sure if you know that, but we have 1.4 million lawyers in Brazil.
Yeah.
It's the largest population of lawyer on earth. We have more lawyers in Brazil than in the US. And we expect to have 2 million lawyers by 2025, I guess. So I'm not saying like, oh, the guy attended law school and now, no, I'm saying like the guy went to the law school and did and he passed on the bar and he is a proper lawyer.
Yeah.
And what's this guy like? When you look at the tech stack of a average lawyer in Brazil, like the most sophisticated stuff that he operates is Microsoft Office and Teams and
the fax
perhaps
machine, and you have to go to the cartoon to get stamps still.
Yeah, most of the things that his guy's doing daily can be automated by a software.
Okay.
So, which is why I started doing something that lawyers hate, which is calculations, automating calculations for the lawyers. And then they started to expand their product offerings with okay, how can we make signatures? Okay, so you don't have to pay for DocuSign anymore or ClickSign. You can have it all together on Justify. How can you be more productive? I can help you manage your agenda. How can we do automatic petitions? They have 13 products in a turnkey solution, and they're they never they can eat. When it comes to growth, it's imagine a company that grows double digits monthly with 0 salespeople, 100% product-led growth. They haven't even touched the investment that we've made because every month it's a surprise. The company generates cash flow.
And I imagine that kind of company doesn't churn much. I imagine the lawyers become pretty dependent on them for their day-to-day.
The more they use, and the more Justify creates new tools to make it a full stack solution, more dependent the lawyer becomes.
Mm-hmm.
And they're still in the early days. So we have other companies trying to solve our problems, but the thing is we're trying to tackle obvious problems that we can leverage with software and build a very efficient powerhouse on top of it. And that's what we believe. There are a lot of opportunities like that in Latin America.
Yep, I agree. Well, this was an awesome conversation, William. Is there anything you think we missed that we should highlight that might be interesting for the audience to know about VC in Brazil?
Well, I guess it's not trying to be repetitive, but it's the most exciting time to invest in venture capital in Brazil because everything is easier right now. The pool of talent is way better. Build your startup is the new going to work at the investment bank.
That's what I was going to ask you, right? We talked about in the beginning, the cultural shift. I think I saw a survey where for the first time, Brazilians coming out of college list startup founder or startup as their most desired job instead of a banker or a lawyer, there's been this cultural shift for sure.
And that is transformative. The moment the nation understands the value of equity and building equity, and that's where you get wealth.
Right. I don't know if we're there yet. I don't know.
We're very far, but we are moving fast.
I agree.
And that's the right moment. There's a lot of opportunities out there. The new MBAs, they want to go to launch their own company, or they want to partner with someone that is building something cool. Now we have this crazy API with the knowledge of the entire world, which is OpenAI, that you can embed into every product that will make everything smooth. The possibilities, they're gigantic. So we're very excited with the moment. This is a good moment to be a VC in Brazil, and also an investor, a founder. And if you guys want to know more about SaaSholic, that would be super nice to connect on LinkedIn or via email. My mail is William at SaaSholic.com. A pleasure to talk to people interested in this matter.
I'll link all that with your Twitter, LinkedIn, and the website, the SaaSholic, in the show notes. And yeah, awesome. I really appreciate you.
That was nice, man.
Taking the time. That was a great convo.